Hi, folks, and welcome to another edition of Money and Politics. Nice to have you with me today. And I know you're going to want to hear all the latest on the market action and just what happened to our stocks. Sorry, folks. You got to have a little humor, right? It was obviously an ugly day, but we'll talk about it. So, what is there to say? And a couple of things. I just want to make sure I was recording there. I just looked back, and on February the 18th, I think it was, I had talked on a down day about how you have to master your emotions to be an investor, and that's still true. So I'm not going to be making excuses. There's no excuses to be made. We pick stocks based upon what's going to happen in the future. And when we feel badly, and it's understandable that we would, to see, our stocks going down, to see money that we had, an investment portfolio that would have been worth thousands of dollars more, just a couple of days ago. It's, it's certainly discouraging to say the least. But as I say, it's when you feel like you've been kicked in the gut, that's when you have to be able to, think. You got to be able to handle that downturn. Markets are going to go up and down, and that's just a given. You certainly didn't start investing, I don't think, with the idea that every day was going to be an up day or that every week was going to be an up day. And when you experience these, you just have to, suck it up. And there's really not much more to say about that. Now, the other thing I would say is a lot of people wisely would say, oh man, I wish I would have had the chance to have bought a stock when it was down, when it was cheap. And on these days when it goes down, you get that chance. So I'm still trying to get my message out here. There's an old saying, I put it on Twitter today, that old saying on Wall Street that the time to buy is when there's blood running in the streets. And today's the kind of day where there's blood running in the streets. Another thing I've said to people when I talk to them about investing, I say, when would you want to buy a Cadillac? When it's worth $80,000 or when it's worth $15,000? Well, the answer is obvious. So when the market goes down, you're getting a sale on things of value, and those values are stocks. The other thing I would say is this is why we've talked before about having cash in your account. When you have stocks go up, maybe you sell one share of this one, maybe you sell 2 shares of that one. Maybe there's another position that you just want to close out altogether. Build up as you go along. Build up cash. That's your ammunition. And so when we get weeks or even months, when the market goes down, that's when you have the ammunition to go in and buy things cheap. And if you don't have cash, what you're going to have to do is sell other things of value at a low price to go out and buy the bargains. Now, so you got to have cash. When we have these down days, that's when some of the things we've talked about become real, right? Building up cash, not panicking, mastering your emotions. When we are investing, and I've used this term with you before, we are investing for the future. So what's the future? If we look at, let's take Humble. Everyone wants to hear about that. Has something changed with Humble's future? I mean, are they not still going to have the app coming out? I mean, just today they started putting credit cards up on there under the Humble Financial Services, kind of like a bank where you can get credit cards through them. I don't look at that as a major new event, but it shows that they're adding services. We just got Tickery. Is that not going to still be growing? That's what, $100 billion worldwide market? As I said the other day, if you get 1% of that, it's $1 billion. Is Brian Foote still not one of the masters of blockchain technology? Is blockchain technology over? Is that an old thing? No, it's still the future. So if you look at the management, where they laid out the timeline for this year, it's still all in the future. We're still executing it. We're going to have the symbol coming in, Humble, not a major thing, but it's something, HMBL, on I believe it's the 26th. So I get it. It's a down day and it's hard to handle, and there's nothing that I can really say to you that's going to necessarily make you feel better, other than to try to put this in some perspective. I was trying to get a chart I have on my phone, and I don't know why it wouldn't. I was trying to mail it to myself and it wouldn't go through. It's a 50-year chart of the S&P 500 from 1970 to 2020, and it goes up and then goes up and down and up and down and up and down, but over time it goes up dramatically. And folks, I lived through that 50 years. We were in the Vietnam War. We had Richard Nixon going through Watergate and then having to resign. We had South Vietnam fall to the communists back in April of '75. There were many things over 50 years that went wrong. Bad news. The Yom Kippur War in the Middle East, the Arab oil embargo of 1973, 9/11 more recently, the impeachment of Bill Clinton, going to war after 9/11 in Afghanistan and then Iraq. A lot of bad news, a lot of bad things we had to deal with. You had the market crash of 1987, where when the Dow was at 2,500, we lost 500 points in one day. We lost like 20%. The market today was down about 1%. Imagine if we had gone down 20% in one day. That happened in 1987. A lot of bad things happened over that period of time. But you know what else happened? The market increased dramatically. I wish I had the chart to show you. The market just shot up over those 50 years. And over that 50 years, you're going to have volatility as we are having it now. And if you're going to be an investor, you're going to have to learn to live with it. And if you can't live with it, then you either don't invest or you invest in things that are really boring and dull. You want to be in Coca-Cola? I've told the story that 5.5 years ago in October of 2015, helping a friend who asked me to take a look at her portfolio, she had Coca-Cola. It was then $45 a share. I haven't checked it today. Let me check it. I don't own Coca-Cola. Okay, 5.5 years ago, it was $45 a share. And you know what it is today? $49.94. You want to buy a stock that goes up $5 over 5.5 years? I mean, be my guest. We are in Humble, and we're in other things. But if I bring Humble up, and this is today's chart, but let's go to a month. Okay. This isn't really showing the volatility as much as I would have hoped. But you're going to have a lot of swings back and forth. And again, that's just to be expected. You look at the top up there, and we see that the S&P was down 51 points. The Dow Jones was down 346 points, I'm going to say, which is a 1% drop. Earlier, it was down 700 points. The NASDAQ was down 275. And crude oil, which doesn't for some reason show up on this chart here, crude oil was at $64 a barrel now. So what does that tell us? That tells us that while your Humble stock is down, it wasn't related just to Humble. This was just a market sell-off. One thing I had thought about bringing up last week, and I didn't, and it kind of pertains now, is that you need to have some understanding, not a whole lot, but you need to have some understanding of interest rates in this context. We are right now at like all-time record low interest rates, the lowest interest rates in my lifetime. But the pendulum is starting to swing back, and we're going to start to have higher interest rates. That doesn't mean high interest rates, but higher than these record low interest rates. Now, how does that affect stocks? Interest rates have been so low that where people normally, when they wanted to be more conservative, would put money into bonds and get 5%, 6% historically. The bond interest rate was somewhere between 5 to 8% over the better part of the last 70 years. Right now, those interest rates are down to about 1%, 1.5%. And so people didn't want to lock up money at 1%. And where are they going to put that money? They were putting them into the stock market. So the Fed chairman spoke today, and the market was spooked because they think interest rates are going to rise, and that might mean that money comes out of the stock market. Okay? That's kind of one of the big things that spooked the market today. I will tell you, I think the so-called geniuses on Wall Street are not geniuses at all. And I would tell you that retail investors like you and me can be much better investors than the guys on Wall Street. And I've seen that over and over again. In fact, Peter Lynch, one of the greatest investors of all time, who wrote a book I would recommend to you called One Up on Wall Street. It came out about 30 years ago, but it still has a lot of wisdom in it. And I bought it when it was new. It might be updated. But, Peter Lynch lays out why the average investor can go out and buy things that the big investor can't. The average investor can go out and buy a little company like Humble. The big investor who's got hundreds of millions of dollars, and they've got to invest a lot of money to make, when they're running a portfolio of 10 billion, 20 billion, 50 billion, they have to invest a lot of money to make their portfolio grow. And they can't put enough money into a little company like Humble. And because we're so new, they probably wouldn't anyway. But whatever the stock is, they have to have they have limitations on what they can do that we don't have. We're not going to be putting $20 million into something. We might be putting $2,000 into something or $200. And so we can maximize returns that they can't get. And these movements when we had Humble, and as I said yesterday, it was still up 500% before today. I haven't checked the interest, what it's done so far. But we were up 500% on the year. So we can still get some good returns. All right, so the Dow was down, the S&P was down, the NASDAQ was down. These are times where you can buy and make good money. You're at $3.15. When you adjust for the split, the reverse split, that's the equivalent of 78 cents. Last Thursday, the last day of trading before the reverse split, we ended at 85 cents. So we're below where we were now before the reverse split. I'm sure that's disappointing to a lot of people. It's disappointing to me. But again, we're buying the future, and I don't think the story of Humble has changed. Nor do I also want to say just about Humble. This is also why you want to have some diversification. I've talked to you about DIG. DIG was actually up today. Not that probably a lot of you don't care necessarily, but it goes to show that when the markets were down, some other things were up. When the stocks were down, I should say, some other things were up. And here's DIG now up to 128. It was up higher in the day. It got up to 132. And why? Because oil went up. Now, why is oil going up? Because we're going to reopen the world economy. That's why. So let me talk, and I'm bouncing around, and I apologize for that. It's just I was jammed doing some other projects here, and I didn't have a chance to really kind of get my thoughts organized. But here's the thing I've said before. When you get a job, and let's say you're hired at $50,000 or so, and you go, hey, Joe, we want to hire you. Okay, what are you going to pay me? What are you going to pay me this month? $4,200. Great. What are you going to pay me next month? $4,200. Oh, how about the month after that? $4,200. It's going to be $4,200 a month for the next year. Now, how do you like that for getting ahead? You're going to have the same earnings the whole year, right? Maybe here and there you get a little bit of overtime, but basically you're going to be making the same. And if you're on salary, you're not going to get any overtime. You're just going to work longer hours. You're going to make $4,200 a month. You know what that isn't? That's not volatility. That's linear earning. You know what you want to have to get ahead? You want to have volatility. The ups and downs where you don't make the same amount every month, every week. And some weeks you're going to go down as you get in this dig chart right here. And then you go up, and then you go up, and then you go back down, and then you go up. But you know what? Over time, you make money. You go up. And that is the thing that matters. When we are working, we have a flat income stream. We work for that income stream. We work for the cash flow. But we have to invest for wealth. And if you're going to be investing for wealth, you're going to have to accept that there's going to be volatility and that your stocks, whether it's Humble or DIG or InMode, INMD, which I've mentioned, you're going to have to accept that they're going to go up and down. What you want to know is the story still good? Is the story good right now for oil? Yeah, we're going to reopen the world economy. Is the story still good for Humble? Yeah, they're in a brand new field, and they're bringing products and services to the second world and third world countries. They've already launched Humble Investments in, 100 different countries. The app is going to be coming out in April. I misspoke the other day. I said the holdup on that was financial. I meant to say legal. Brian Foote has said the holdup. They're just trying to get down all the legalities nailed down. So, yeah, I think the story is still good for Humble. And so when it goes down, instead of lamenting it, I want you to go, hey, gang, they're selling Cadillacs now for $15,000 instead of $80,000. This is the time to buy. The people that can save money in their account, build up cash along the way. I don't mean that you have to liquidate positions. You know, just pick some apples off the tree. Build up some cash. And when the market goes down, and inevitably it'll have dips. Every year there's going to be some period of time where we go down. You're going to be ready. And that's the nature of making money in the market. When it goes down, now is the time you buy. I should have started this way. I have this talk I sometimes give, and I say to people, and I'll close out after this, hey gang, let's say I'm talking to 400 people. Raise your hand if you want to be wealthy. How many hands go up? Every hand. Okay, put them down. Now let me ask you a question. Are most people wealthy? And the answer is no. Okay? So the kicker to the story is, if you want to be wealthy and most people aren't wealthy, don't do what most people do. If you're following what most people do, you're not going to be wealthy. And you know what most people do? They don't read a book on investing. They never start investing. When the market goes down, they sell. When the market goes up, they buy. The guys that make money read about investing. They educate themselves. They take risks. When the market goes down, they buy because you're going to get stocks lower. And when the market goes up, they sell or take some off the table. You buy low and you sell high. It's that simple. And over time, even though we're going to have this volatility, you're going to make money over time. You're not necessarily going to make money this week. You're not necessarily going to make money this month. There are certainly some bad years. 2008 was one where the market just crashed. It went down, 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 and then we got to September and it went off a cliff. That was a horrible year. No, virtually nobody made money then unless they were shorting the market. Part of the game, folks, and you gotta understand that and learn to live with it. There's some strategies we can employ. We've talked about some of them already. I'll continue to share some as we go along. I can't, unless we had a weekend together where we spend, 8 hours a day on Saturday and Sunday. I can only share so much with you in the context at one time. But you have to be willing to just hang tight and look for good stocks, and don't always be in the same marketplace. Sometimes you want to be, investing in something like agriculture and technology, things that don't have basically anything to do with one another. And over on the other hand, you have oil. I've talked before how investing is like putting together a baseball team. They're all baseball players, but a pitcher doesn't do the same thing as a catcher, and a third baseman doesn't do the same thing as someone who's out in the outfield. So we buy stocks like that. We got to have stocks for different purposes. I know it's disappointing. I'll wrap up at that. I don't know that I necessarily helped you today, but lick your wounds. Who knows what the market will bring to us tomorrow. I do think what I'll do is have give some thought where, when I'm not jammed on time, try to give a better overview of the market. I kind of touched on it tonight. I would say that overall 2021 is going to be, my expectations as I am here on March the 4th, 2021, I think is going to be a good year. I think we're going to have some really positive news coming out as far as growth. Tomorrow morning, by the way, is going to be the jobs report. We'll see what happens there. I haven't heard what the expectations are right now, but that could also be a market mover, and that comes out at 7:30 a.m. Central Time. But whatever it does, we're going to be having a pretty good year in 2021. And then after that, I'm not so sure. I'm not so sure that 2022 is, I think there's reason to think that 2022 might be a tough year. So I'm kind of approaching this from the attitude that I want to make money up front this year, because I think 2022 might be a tough year. I could be wrong. Who knows? In any event, I'm sorry for going so long. I try to make this a little more concise, and I didn't today. But I appreciate you watching. Thanks for all your comments, and we'll see what the market brings to us tomorrow. Okay? Take care. Thank you, everyone.